at the IMF. He's now a professor of international economics at Harvard University. So really great to have you on. I'm sure you're watching and thinking, what is the next step here to ensure that we don't see contagion within the banking system. What are your thoughts initially on seeing what's happening with First Republic on the back of what happened with SVB?
Well, I think they're aware that they were very generous with SVB to the depositors. They were supposed to guarantee deposits of $250,000, and they were guaranteeing $3 billion and up. And that money, particularly the big depositors, tends to run faster. And so if they don't guarantee it, there are a lot of banks which would have problems quickly. But if they do guarantee it, you have to put some parameters on it. Yeah. There's a lot of losses in the banking system still. There are other banks vulnerable, not just First Republic. And they know that whatever they do with First Republic's got to set an example of what everyone else should expect.
So, and if they step in to assist, that also then, I guess, sets a precedent. CNBC reporting that First Republic would likely go into receivership. What is your view on this?
Well, that seems like a distinct possibility. The problem when they put the bank into receivership, as opposed to getting another bank to buy it as an ongoing concern, may be greased by some government money. So it goes into receivership, it really falls apart. The depositors leave, the people who are depending on loans get orphaned. And so there's sort of a balance to strike. I would also just like to say one thing about Silicon Valley Bank, if I may. It was lending to the startups. It was the most important lender to the tech sector, to the most successful sector in the world. It is the pride and joy of the US economy that produced trillions of dollars in returns. And so there is a balance regulators have to think about between putting the financial system into a coma with its regulation and at the same time not, being too generous with taxpayer money. It's not easy.
Absolutely. It's not easy, absolutely. I mean, and seeing this report and basically a post-mortem on what occurred, the Fed also saying, look, we could have done more. We knew there were problems. When we found out there were, we should have stepped in a lot more aggressively. What do you make of these findings?
That's absolutely true. I think on the one hand, it grew so fast, the regulatory team, which was sort of not up to doing something so big, was sort of out of its depth quickly. But I think when they gave alarm bells to Washington, Washington really is partly at fault for not saying, you've got to crack down. The signals were coming. I mean, somebody was making the decisions. It's the San Francisco Fed, not just the supervisor, but also the Washington Fed. So they're rightly, saying we should take some of the blame. Maybe they're not quite giving themselves enough of it.
In terms of that $250 billion threshold, right, that number clearly we saw a loosening of regulations around what is considered systemically important. To change that figure, to get more regulation in, I mean, it's got to go through the process of people signing off. It could happen only in a while. Do you think that's vital in terms of creating buffers within the US banking system?
I don't think there's any question that they overshot when they went to 250 billion. It will be viewed as been a mistake. But bear in mind that there are a lot of loans and a lot of financial activity that gets done outside the regulated banking sector. And the more regulations they put on it, the more they push things outside of it, which aren't regulated. And they're also worried about that. I think all of banking regulators, central bankers, are incredibly worried about what we call the shadow banking system, which has just grown as regulations have grown. So even if they fix the banking sector by shrinking it, what do they do with the shadow financial system, which they're expanding?
That's a really good point. The last question I have for you, I guess, the first thing is, what impact does the interest rate hiking cycle have on banks? And then secondly, what are you thinking in terms of contagion and concerns that this is not over yet? There's still trouble brewing in the banking sector.
Well, they had these things called the stress tests, which were supposed to check to see if the banks could handle problems, but they didn't check for raising interest rates really fast. They hadn't been looking at that, so they're going to fix that. But they have raised interest rates a lot, and there are a lot of losses on the books of the banking sector. Given time, they can earn it back because they pay a much lower interest rate to depositors than they get. But there'll probably be more trouble to come. Financial crises go in waves. They don't just happen all at once. They can be separated by months, years even. I don't think this is over.
Okay. So great to have you on. Thank you so very much, Ken Rogoff, there for us.
Thank you.
All right, let's move on.